Welcome to the Future of Payroll and Workforce Management Insights by HR.com, your go-to resource for insights into payroll and workforce management. From navigating compliance and technology trends to exploring the latest in global payroll solutions, we're here to keep you ahead of the curve. Join us as we dive into the forces reshaping payroll and share practical strategies to optimize your workforce management. Let's get started. Well, hello everyone, and welcome to the latest episode of Future of Payroll and Workforce Management, a podcast here at HR.com, where I am your host. My name is Brent Skinner, and you've heard enough about me on previous episodes, so I won't bore you again. As is every episode, this one is about my guest, and today's guest is Dustin. Hello, Dustin.
Good morning, Brent. It's great to see you, man.
Yeah, good to see you too, man. And I believe you're hailing from Buffalo, New York. Is that correct?
Yes, sir.
Awesome. Sorry to give everyone your GPS coordinates right there, but
That's
it's a
okay.
big city.
They're not headed this way. It's 30 degrees in the middle of May, so
I'll stay away too. Yeah. So you are Dustin Snyder, and you are founder of Wayforward and author of a really cool book, Sink or Swim. And we have a working title for this particular episode of the podcast. I think we might keep it. It's what if people problems are actually profit problems? And I love that because it really gets right down to the essence of something that's on a lot of people's minds, and I've been kind of thinking about a lot over the past several years, to be honest with you. And we're going to get into that because there's a lot to cover, and it really does intersect very interestingly with payroll and workforce management, believe it or not. But first, as I like to ask all my guests, what got you into this? What inspired you to write your book? And what got you into the world of work? There's a lot of passion in this space. I love hearing these stories.
Sure. So I came up through the labor relations field, actually working with unions. And so that was a lot of investigations, grievance hearings, arbitrations, things like that. And I was very lucky to be in the right place at the right time a lot, get exposed to a lot of strategic things, and eventually took on some executive HR roles, which culminated me being the VP of HR for the American division of a global manufacturing company, a metals company. And a couple years into that, the parent company asked me to take over as president of that division as well. And so I had the really cool, uncommon jump from from HR into the chief executive seat of a division. And I'd love to say that I knew what I was doing all along, but I think I stumbled accidentally into what I do today. I will admit that I had a very command and control leadership style for many years, and I very clumsily pivoted into more of a curiosity stance about what was truly going on in the rest of the organization and on the front line, and was able to turn around things pretty spectacularly in that organization. Not alone, certainly, with the help of a wonderful team, but started to understand that there was some really incredible science in what's called the field of human systems theory, and starting to understand human behavior in a way that I think doesn't always make it to human resources and management and the MBA schools and things like that. And so after that, I launched Wayforward, and for the past 5 years, I've been applying that newfound knowledge of human systems theory to help other companies change their trajectories by understanding their workforces in a much more objective way, that it's truly not a soft science. It's very much a hard science that you can map and predict and change outcomes with.
Yeah. And that's really interesting. And we're going to dive into that, but I kind of want to set the table because you really made me think here. And because one of the things we're going to do today is we're going to kind of look at how workforce behavior is often dismissed as soft or unmeasurable, right? And there's sort of a paradox there because in a way it does elude measurement, but at the same time, in a way, we've figured out ways to measure it, but there's, in terms of a very sort of financial way, it
Hmm.
eludes measurement, and yet it has a profound, undeniable impact on financial outcomes for organizations. And so there's this weird disconnect. Um, I'll say the word weird. I'll use the word weird. It's like this weird disconnect where it doesn't translate to sort of gap, like generally accepted accounting principles. Somehow
Hmm.
it doesn't. And so there's a blind spot. And so there's almost this weird inclination not to believe it on a certain level, right?
Yeah.
And yet we know. And so that's what I really want to get to today. So, maybe we start with the first question that we have is, and this is a good segue, I think, because you describe employee behavior as a system output, right? And I heard you talking about human systems a moment ago. Yeah, so like a system output issue rather than an individual issue. And how does that fundamentally change how leaders should respond to performance challenges? Like, what's going on there?
Sure. So, I'm not saying that there aren't character flaws that exist in the world. If Dustin is a bad employee, certainly, address that with Dustin. But when you're seeing common routine behaviors, when you're seeing systemic things happen with many people in the organization, I'd say more than half of the work that I've done over the past 5 years is companies that want to understand why they have so much turnover, because they know that there's a really big cost impact there. They don't capture it in their accounting, but they they know at some level that it's really hurting their business. Um, so when you have a common behavior like turnover or disengagement or low performance or absenteeism, things like that, that means that there is a rational driver of the behavior. The behavior is downstream from something else that's driving it. As much as we like to think that we're captains of our own ship and we're making our independent decisions all day long, we know from science now, from many different fields, that the majority of our human behavior is driven by the variables in our surroundings, and that we're not unique in that. That's pretty much every organism on this planet, and we are not somehow exempt from it. And we can't leave those, hundreds of thousands of years of evolution at the door when we walk into the office. So understanding that and just reaching that conclusion and saying, okay, if this is a common behavior and it's not just this one person who's got character flaws, then it is rational. And if we begin with the assumption that the behavior is rational, then we can trace it back and say, why is it occurring? What are the root causes that are driving this? It's not just that, the next generation doesn't want to work anymore. That's been a headline in newspapers for 150 years if you look back. So it's not just, Gen Z doesn't want to work anymore. It's not just that, everybody has these character flaws. It's okay. What is it about the surroundings of these people that is causing this behavior directly? And you can start to connect those dots. And once you do that, it's really hard to unsee it.
Yeah. It makes me, reminds me, just a little bit of levity here. It reminds me of that saying, the beatings shall continue until morale improves. Right. And it's almost like a societal thing. Like, I actually didn't know that the headlines basically have said the same thing about 150 years, that, oh, the new generation doesn't want to work, doesn't want to work hard or whatever. Right. And,
Hmm.
it really makes you think about, what if it's almost like we have an idea of how things should be, and we're trying to just fit everyone into it. And it's very interesting because and what I'm getting from what you're saying is that if we sort of just open our minds a little bit and realize, hey, we can change. Maybe we should alter our organizational structure or our culture or something somehow to kind of accommodate how people naturally are.
Hmm.
That's what I'm kind of hearing from you, and maybe this sort of segues into our next question, which is, why do traditional financial models fail to capture the early impact of workforce issues like disengagement or turnover? And
Hmm.
let's get to that. But what is kind of that bridge? Like, what is it about the modern sort of work world that's kind of at odds with with our hundreds of thousands of years of evolution.
Hmm. Yeah. Um, so I can answer both those questions. I mean,
Yeah, yeah.
if you begin with from the assumption that, okay, what makes it safer for people to deviate from policies and procedures and expectations than to follow them? Because our brains are telling us you need to behave this way in order to survive in this environment. And so we can discipline and we can counsel and we can write new policies, and unless the environment changes, our brains will not let us behave differently. That's why I think, the audience is HR folks, and we have this whole progressive discipline setup that we use in HR. And uh, I would challenge any HR person out there to think about, all the instances of exposure they've had to that. And does that ever really work? Like, does that ever really totally change someone's behavior and they're a brand new man or a brand new woman? Like, I really can't think of an example where that intervention actually produced the desired outcome. Because it's not designed to, it's designed to limit liability. And if you engage with your workforce's behaviors in a way that treats them as a liability, as an adversary, people can feel that. So again, there it goes back to, tracing it back to their environment, and
Mm.
people don't like to be controlled. We're not going to respond well to that. Um, but on the accounting, on the payroll question, um, accounting wasn't designed to capture human behavior. It was captured to measure raw materials and things like that. So accounting tracks payroll because payroll is easy to count, but payroll is not only a lagging indicator, but it's a fraction of the actual cost that a person really represents to the business. And
Mhm.
if we think about, why we set salaries where we do, it is a it is a fraction of the value that they create for the business. If we paid them the full value of what they represent to the business, we wouldn't make any money as a business owner. We wouldn't get anything back for that risk and that outlay of capital. So when we think about somebody's impact as their salary, we are forgetting the whole point we set up. That's why we set up that salary the way that we did mathematically in the first place. So, like, when someone leaves, when someone disengages, when a role sits half staffed for 6 months, the research shows us that the financial damage runs anywhere from 2 to 5 times the salary of the individual. And none of it shows up on any line that our accounting team or our CFO is trained to watch. So businesses keep optimizing the visible piece. They cut headcount, they freeze wages, we squeeze the benefits. Well, we're kind of ignoring this whole iceberg underneath. And then if we keep talking about the math, like, it should really make CFOs pretty nervous.
Yeah, yeah, it should. And I love the fact that you use the analogy of or the metaphor of the iceberg, right? Because there is so much underneath the water line. Like, this is what we see in the accounting spreadsheet, and then there's everything else underneath, and that's what sent the Titanic to the bottom of the sea, not the little piece of the iceberg. That's what
Not
they
the top.
saw,
Yeah.
and not in time, right? Actually, this metaphor works great. They saw the top of the iceberg, but it wasn't in time to move this enormous ship, which is, it symbolizes your organization, in time to miss everything else. So you might have already hit the iceberg anyway underneath, right? And
Hmm.
I love what you also had to say about um, liability and asset, right? The cost, payroll is an easy cost to measure. It's right there. It's one of the most readily apparent costs of running the organization. Um, and in GAAP, it's actually people's pay is categorized as a liability, like in the
Hmm.
parlance of
They're on the
accounting, a
liability side
liability.
of the balance sheet. Yeah.
Yes, and instead of an asset, right?
Yeah,
Which
you
is
buy
which
some
is
you buy some steel, or you buy some, patient gowns, or you buy some computers. They're considered assets. You buy a
exact.
salary, you're considered a liability.
But your salary should be an asset. It's a value. It's a partial representation of the full value.
Hmm.
that you provide to the organization, and therefore an employee is an asset. So there's this fundamental sort of disconnect in how, and so it's really interesting that we're really kind of talking about broadening organizations' concept of how they look at their organizational health from a financial standpoint.
Hmm. And and the a lot of our KPIs, especially in HR, they're activity based. They're not outcome based, which is a challenge. Time to hire is one of the things that we'll use in or or cost per head count. We're not looking at things that are more leading that allow us to treat people as assets. You can hire somebody really quick, and if they're a bad hire, we know that a bad hire can cost up to 3 times their annual salary in the first year alone. Um, but there's all these other activities that when it comes, I'll just keep running with the turnover example because it's a convenient one. But you got recruiting and onboarding. There's not the cost of the donuts in the conference room and the slideshow presentation on safety and their tax withholdings and stuff, but like the actual things that go into making sure somebody's onboarded successfully, that's a usually considered like a $25,000 cost to the business. The productivity ramp, 6 to 12 months before somebody's really at full capacity. That's an average salary right there. The departing employees' productivity decline in their last couple of months, the knowledge transfer loss, the drag on coworkers' productivity while they're picking up the slack in the vacancy, and then the turnover that can beget in the next place. The customer disruption, if the role is customer facing, the manager time spent on every part of this process. You run that across an organization with a average $70,000 salary, with 100 employees. If you have modest turnover at like 15%, 15 departures a year, that's over $2 million. And so against the payroll line, that's maybe $7, $8 million. And so like you're looking at 25, 30% of your payroll cost, and not a single penny of it is on the income statement as turnover.
Yeah. Yeah. It's so much in the blank. This is actually a great segue into the next question, in the time we have left here. And that is, so how can organizations, begin translating behavioral patterns, which feel free to dive into a little bit more there too, right? But translating those into something that financial leaders can really understand and measure and act on. Like, how can we sort of bridge this gap?
I would say the best thing you can do is, I'm not saying throw out all of your KPIs and throw out all of your accounting standards, but to to just focus around the principle of build a parallel set of leading indicators rather than lagging indicators. And if you're unfamiliar with that, people can Google the things that come out of my mouth. Um, but track system health on the human side, the way that the financial ratios track financial health. So look at the things up front, like decision velocity. How fast can the organization make a decision about an issue that's dragging them down? Um, what is the regrettable turnover? And how important are the roles to the organization? If a hospital's desperately losing nurses and we're not making a decision about it, those are things that are in front of it hitting the financials. Um, are we actually, what's the time to productivity, and how are we defining the productivity standards in our organization? Are we training button pushers, or are we truly training people who are excellent at what we do? Um, that's the kind of thinking that I want people to consistently be thinking upstream of the thing that they're experiencing. Treat the behavior as a symptom rather than the thing to be addressed. Say, if this behavior is a rational outcome of the environment we've created, what is upstream from this that's driving it? And always move everything as far upstream as you can from from the actions you're taking to the outcomes you're trying to produce to the actual measurements. Measure as far upstream as you can, because it gets in front of what's actually occurring. If you're measuring things after they happen, then you lose the opportunity to do something about it.
Yeah, absolutely. It's really about introspection as an organization. And I'm even seeing an analogy with sort of holistic medicine versus, treating the symptom with sort of conventional modern medicine, right?
Yeah,
Which
I've
is
had this cough for a year, and the cough medicine is just not helping.
exactly, right.
Yeah.
Exactly. Exactly. We don't have to go down that rabbit hole, but that's a really good analogy. Um, Dustin, Dustin Snyder, author of Sink or Swim, founder of Wayforward. Thank you so much for being a guest on the podcast. This has been really interesting.
Of course, Brent. Thank you. This is a fun angle to get to talk about.
Thanks for tuning in to the Future of Workforce Management and Payroll Insights by HR.com. We hope today's episode brought you valuable insights and fresh perspectives on the future of payroll and workforce management. Be sure to check out more episodes and explore resources at hr.com/podcast or wherever you listen to podcasts. Until next time, keep innovating and making a difference in the world of payroll and workforce management.